Alright, so the other day when I was filming my Mag 7 versus the fan favorite stocks analysis video, I went on this huge rant about how much I hate Airbnb and why I think their business model is terrible. And so that led me down the path of revisiting the hotel industry, and I think I found a business that even Warren Buffett or anybody who thinks like him would really love. Today we're going to be talking about Wyndham Hotels and Resorts, ticker symbol WH. And as you can see on your screen right now, when we zoom out and look at their total stock market history, it's very short-lived. They debuted on the stock market in May of 2018 at about $65 a share. And I know when you look at this number right here, it's like, what? Why would I be interested in this company if their total return is only 21%? Because this only takes into account their share price appreciation. It's disregarding the dividends that were paid out. So, in this video, we're going to be doing a deep dive and an analysis into Wyndham Hotels to figure out if it's a dividend compounder with cheese. And in order to do that, we're going to be looking at their story, their financials, and fundamentals. If that sounds good with you, let's go ahead and get into it. And if you're new to this channel, my name is Amos, and this is basically how the video is going to flow. If you stick around until the end, I'm going to be talking about what I believe Wyndham Hotels, their intrinsic valuation to be, but also a good buy price and my personal game plan. First up is going to be the business overview. How exactly do they make money and what is their biggest growth driver going forward? So Wyndham Hotel and Resorts is the world's largest hotel franchisor with over 9,300 properties right now, which means they have over 907,000 available rooms. And all of their hotels are franchised, which means 100% franchised. So when you think about it, Wyndham does not own or operate the hotels themselves. Instead, the franchisees will do all of the heavy lifting and work, checking in the guests, taking care of the rooms, and making sure that the hotel experience on the ground level is up to par. So you can think of it as like McDonald's except for lodging. And in order to use the Wyndham brand and name, the franchisees pay approximately an 8% fee. We'll talk more about that here in a little bit. And of course, Wyndham does do stuff behind the scenes. It's not like the franchisees are just paying a fee to Wyndham and they do nothing. They take care of the online booking experience, the marketing, and everything else in between, the technology side of the business. And when we think about Wyndham's hotel portfolio, they own 25 different brands. However, their most recognizable, in my opinion, include Days Inn, the Howard Johnson, commonly referred to as the Hojo, La Quinta, Ramada, Super 8, Travelodge, and Wingate. And if we're going to be honest, you probably recognize a few of those names. So if we were to sum it up in one sentence, the Wyndham Hotel portfolio is primarily the budget-oriented, affordable options, even though the mid-scale brands make up 46% of their available rooms. I would argue from their 10K, they even say that they like to target the younger demographic and customers that are more wary of prices and who tend to be more frugal. The kind of motel you go to if you just need a place to sleep for the night during a road trip. And based off of my understanding of their business model, I think they're the Walmart of the hotel world. I mean, I spent the last 72 hours digging into their materials and researching about this company, and I think that's a really accurate statement to make. So in other words, they're not a Marriott or a Hilton type of business. So how exactly do they make money? Through the franchisees owning and operating the hotels on behalf of Wyndham and them paying the fees. Let's take a look at some of the fees right here. And as you can see on your screen right now, these are the fees that a potential franchisee would be looking at if they want to start up a hotel under the Wyndham brand portfolio. The low estimation is around $51 million. The high estimation for some of their more upscale and mid-scale hotels would be $94 million. That's a lot of capital. On the other hand, if you want to franchise a Subway, I was looking into it the other day, it only takes a few $1,000s to open up one branch. However, I think Subway likes for you to open up multiple at once. So it's going to multiply by however many branches they require you to have. Probably no less than 5 or 7 branches within one single area. So it does get a little bigger in the price tag. And as we scroll down to look at their ongoing fees, the franchisees have to pay a royalty fee, about 5% of their gross revenue or gross sales, and 3% for the marketing and advertising. Those are ongoing. And as we scroll down, you can see there's a ton of fees and royalty paychecks going into into the pockets of Wyndham from the franchisee. And funny enough, when we think about their biggest growth driver going forward, I think it's Airbnb shooting themselves in the foot. Yes, Ronald, I'm absolutely joking. However, honestly, I think it's going to be the growth of their franchise team, because the franchisees are the ones that are going to be paying for the construction and upkeep of new hotels, unlike McDonald's. I think McDonald's does pay for the construction of the location and of the building itself, but with Wyndham, they're hands off. So when you think about it, if more franchisees join the Wyndham family, they're going to build out more hotels, which means more fee-based revenue for Wyndham hotels. And the best part about this business model and strategy is that Wyndham has very, very little capex. And we'll talk more about that as we dig into their financials and numbers. However, to Wyndham, they think their biggest growth driver going forward is going to be their credit card, because as more people sign up for that card, they're going to benefit from the fees whenever they have a transaction or whenever they check into a hotel and whatnot. And if you want to do more market research about the hotel landscape and industry, well, these are their best categorized peers, rivals, and competitors. Now let's talk about the arguments surrounding Wyndham. Number one, it's a very saturated and competitive industry. Just like the burger stocks video that I made, there's a ton of options for hotels no matter where you are in the US. It's not like Wyndham has the upper hand or that they're the only player in this space. There's a ton of other hotels. Number two is another pandemic-like event shutting down the travel and hotel sector. So a travel industry risk. For instance, 2020 was absolutely devastating for their bottom line, but they still managed to be okay. However, on the other hand, when we think about 2009, the last big great financial recession, well, their revenue dropped by 12.4%. To kind of give you a picture of what would happen during a big economic downturn. And then number three, if the van life or RV movement gains more traction, it's going to hurt the bottom line for Wyndham. Because why pay to stay at a hotel if you can just haul your RV around for your family vacation? So enough with the negatives, and now let's talk about the bull case for Wyndham and if they have an economic moat or not. Number one, I have asset light. This is a franchise business model, which means less overhead costs and more free cash flow. It's kind of similar to a software as a service company. Crazy to say, right? A hotel business. Number two, I have the Wyndham Rewards program. It incentivizes their target demographic to be repeat customers because they can rack up and accumulate points for a free stay. So it's the gamification of racking up more points by staying specifically at a Wyndham hotel. And globally right now, they have about 115 million members. That's pretty wild. Just to put it into perspective, if you think about the US, that's about a third of the entire US population. In fact, 37% of all of their check-ins for this past year were part of the members program. So they must be doing something right if people keep coming back. If 1 out of 3 customers checking into a Wyndham belong to their rewards program. And based on their math and numbers, the enrollment for the membership program is growing at a rate of 8% year over year. And then number 3, I have extended stay. So extended stay is a category of hotels that's meant for people who stay for no less than like 3, 6, 9, or 12 months. It's not for the people who just come for one night and leave. And Wyndham is strategically building out more hotels near new data centers that are popping up all over the country so that the engineers, data scientists, and everyone else that's involved with that project can stay at their hotel for 6 months at a time or whatever their contract agreement is. But it's not just to ride the waves of the data center movement. There's also a ton of people who want to buy a home right now, but they're waiting out the interest rate environment. Because I don't think it's fun for someone to take out a mortgage loan with like an 8 or 9% interest rate, right? So I think some people are just sitting out and staying in a rental, but there's also probably a good chunk of people that are staying at an extended stay, probably a new Wyndham building. And when I think about their economic moat, it's their network effect. About 80% of the US population lives within 10 miles from one of their hotels. They're practically everywhere. It's kind of like a Dollar General or a Walmart. And before we get into the numbers and the metrics, let's quickly go over the recent earnings report and latest updates. So bottom line up front, it was a pretty darn good earnings report in the now. However, for the future, it was negative guidance and outlook. So let's talk about what happened. Most recently, they added about 15,000 rooms to their portfolio. And in the hotel industry, they measure their financial metric as the revenue per available room. So 15,000 rooms being added means the revenue is about to increase by a whole lot. And they posted the biggest growth in metric increases in the Middle East, Europe, and Asia, except China, where the revenue per available room declines by 8% year over year, which means travel in China is slowing down. And Wyndham is saying that the US revenue per available room is expected to weaken for the rest of this year. And seeing how about 55.4% of all of their rooms are based in the US, yeah, this did not make Wall Street happy, and that's why they've been going on a sell-off in the recent weeks leading up to making this video. Alright, friends and family, now we have made it to the numbers and the financials part of the video, and I realized I'm a little long-winded and I talk too much, and I think people get bored from this section. So what I'm going to do is kind of speed run it, and you're going to see numbers that are highlighted by green, red, or just left alone. If it's green, that means I want to call out something good about that metric or number. If it's red, it's something that we need to talk about because it's a red flag. If that sounds good, let's move on to the next slide, and it's going to fill everything in. So the first thing that I want to call out is their trading multiple as depicted by the forward PE ratio. Right now it's a 16.4, which is pretty darn low because historically their 3-year average is sitting at a 23.6. It usually trades for a premium, but as of right now, not looking too hot. So I highlighted it green because that's one indicator or signal that we can look at to see if a company is undervalued or not. And something else that I highlighted green is their net income. This is the bottom line, the earnings per share. You take their bottom line divided by the shares outstanding, it's $4.25. We want to remember this number because it's relevant and very important to the dividends paid out. And that's an increase year over year by 48%, which I think is absolutely fantastic. And this right here I've highlighted in yellow because their debt situation, usually we want to see a debt to EBITDA ratio of 3 or less. But something that we want to keep in mind is that unlike Marriott, which is another hotel brand that actually owns their property, so they have a lot more operating costs, with Wyndham, they don't do that. They virtually own zero real estate on the books, which means when you think about their operating risk, it's pretty much non-existent. So the 4.2 might sound high and scary, but I think with their business model being fee-based and reoccurring cash flow, it makes their EBITDA a lot more predictable and the debt situation not as scary. However, it depends on how you look at it, so I highlighted it as a yellow. Neither good or bad. The next thing that I want to call out is their operating margin. Essentially, what is the profits that they make from their operations? And as we just learned, they really don't have any operations except at a high level and at the corporate side of things. And that's why we're seeing a 39%, which is a growth year over year of 23%. They're doing the right things, friends and family. The next thing that I want to call out is the return on invested capital. Anything above 10% is pretty darn good. And because they don't really have that much CapEx, it results in a very healthy ROIC. It's 11.7%. Their 5-year average is 9.2%. So things are going up and to the right and in the right direction and trend. It's a good thing. And I know I didn't highlight this, but I want to address it. When we think about their CAGR, the compound annual growth rate, when you take into account the dividends paid out plus the share price appreciation, which I think is a more accurate picture of what's the return on investment if we invest into a stock, it's 11% for the past 5 years, year over year. On the other hand, as a benchmark, we like to use the S&P 500, but if you know anything about the stock market in the last 5 years, the tech companies, including Nvidia, Microsoft, and all the other big dogs, they really propel that growth story. So that's why I think it's a little skewed to compare a hotel company to those big, giant tech companies that really propel the growth for the S&P 500. Because if you eliminated the Mag 7 from the S&P 500, I think the CAGR would be closer to like 11 or 12%. Anyways, moving on to the dividend profile. I have their dividend payout ratio highlighted in green because 38% is really freaking healthy. Which means out of their bottom line, their earnings per share, $4.25, of that, they use $1.64 to pay out to the shareholders as dividends. So what's left over, they still have plenty of retained earnings and plenty of cash, right? So I think that's pretty good. And the dividend is growing at a rate of 8.2% year over year, but historically it's closer to 10%. And I have this highlighted in red because I think this is a negative call out. Their free cash flow per share is $2.85. So we can still afford the dividend, but what I don't like about their free cash flow situation is that it decreased negative 28% year over year. And upon further inspection, what I found out is because Wyndham spent more than they would like on their advertising and marketing budget. In fact, they overspent by $22 million. They usually have a lot more free cash flow left over, but I think they're trying to aggressively scale and attract more customers right now in 2025. So not a good picture, but at least it helps you understand what happened. And now let's take a look at an example of potentially investing $10,000 into Wyndham Hotels and reinvesting the dividends paid out back into your initial investment and not putting any more money into that initial 10 grand. And let's see what happens, right? Year one, your expected dividend payout would be $209 based on their dividend yield of like 2.07, 2.09%. End of the year balance would be $10,700. And by the way, we're making the assumption that the share price of Wyndham is going to grow at a rate of 5% year over year, which I think is really, really conservative as an estimation. And as we fast forward throughout the years, I mean, just look at this beautiful picture, right? By year 10, we can expect $3,000 in dividends and that initial 10 grand to transform into $20,600. And if you're not a visual person, we can scroll down and take a look at it. Starting here, $10,000, which means about 126 shares. And as you fast forward, by the end of 10 years, you would have about 159 shares, and the portfolio balance should be at about 20,600. But this is all hypothetical, just to illustrate the power of dividend growth investing, which, based on what we see right here, I don't think it's too bad. I like what I see. And now it's the part of the video where we try to calculate and determine an intrinsic valuation for Wyndham Hotels. But before we get into that, we want to assess what has been their one-year metric, the highest price that they achieved in the past 365 days, and the lowest price. The highest price, as you can see on your screen right now, is $113. The lowest price is $70. And at the time of filming this video, they're currently trading for about $79 a share. Needless to say, they're pretty much around that valley bottom price. Now, based on the Benjamin Graham's valuation model, it spit out $76.55 a share. That's the inherent worth of Wyndham Hotels. However, I like to do a second valuation model just to cross my T's and dot my I's to make sure, is that number accurate? Because that means right now, Wyndham Hotels is technically overvalued and overpriced and too expensive. $79, whereas their intrinsic valuation is $76. So by using the dividend discount model and plugging in a 5.6% growth rate for their dividend payout, even though historically it's 10%, and using a weighted average cost of capital of 7.2%, well, that spit out $108 a share. So we have $76 on one hand, super bearish take, I know, and then $108 a share based on their dividend profile, which is just shy of their one-year high of $111 a share. And if we averaged out the two, then we get a forecasted price for Wyndham Hotels in the next year to be about $92.40. That's not financial advice, it's just based on my math and calculations. So that's what we think. But the number we want to keep in mind is this 108. So $108 a share. What does Wall Street and the analysts that are covering this company think? Well, on average, they believe Wyndham to be $108 a share. From their current trading price, that's an upside of 36%. And the median price target is $110, which is an upside of 39%. So Wall Street is effectively saying 108, and based on our dividend discount model, we said 108 as well, which I think is hilarious, but also kind of crazy. So thinking about the Benjamin Graham's valuation, I think in this case, I'm gonna have to discard it because in my humble opinion, I feel like that valuation is just too bearish and too low because the lowest price forecast for Wyndham is 94 bucks. 76 is just, it's too much. It's an outlier and too extreme. So if we think about 108, which is the number that Wall Street says, but also I do, let's just go ahead and say 108. So keeping that price in mind, what's a good price to buy into Wyndham if we bake in a margin of safety, a risk-adjusted stock price? So taking that into account, 108 is their intrinsic valuation, then a good price to buy into Wyndham would be $86.40. That's not financial advice, it's just a good price in my opinion. A bargain price to buy into Wyndham is $81 a share. And a steal of a price in the US that's slang for a really good deal would be about $75.60 a share. So just in line with the Benjamin Graham's valuation, which is why I'm saying I think that is a little too extreme and a little too low and a little too negative. Which takes us to the final verdict. What do I think about Wyndham Hotels and Resorts after spending my entire weekend just studying and getting to know this company because of my hatred for Airbnb? If I could sum it up in one word, it would be that they are a sleeper. They are flying under the radar, and I think they're really good. Their recent sell-off is based on the economy slowing down, and they're already pricing in that the travel industry is going to take a hit. However, after getting to know them, I think their business model is going to be resilient because it's not like they have hotels that's catered towards the luxurious and fancy and expensive lifestyle folks. No, most of their hotels are mid-scale or budget-oriented, right? And I think if more people are going to be cognizant of their spending, I think they're going to go with the budget option when they do go on their family vacations. Because as an American, there's something that we really love, which is cheeseburgers, beer, fireworks, freedom, yes, but we also love to take vacations. And family vacations is something that we will never neglect. And I think more road trips are going to be coming up, especially now that it's summertime, so I think they're gonna be okay. So even though the Wyndham leadership team was like, hey, we might have soft sales for our US market for the rest of this year, I think they were just being cautious and just saying what's up. That doesn't mean that's gonna be reality. I think they're gonna be okay. Now with that said, I could absolutely be wrong and they could just crash and burn and people just stop going to hotels. Yeah, I could be wrong, but I think they'll be okay. So their grade, if I were to compare them against other companies and how they evaluate in the stock market, I think they're a solid B. I think they're above average. I think what I saw, I liked. And are you going to be angry at me and click dislike on this video if I say overall, I think they're pretty decent? Because to me, I think a 11% CAGR year over year is pretty darn decent. That categorizes them as a dividend compounder. However, I can't say that they have cheese yet because their stock market history is too short. I wish it went beyond 2018 so that we can see for the past 20, 30, 40, 50 years to see what's in their DNA and how they usually react or behave. But what we have to work with for the past 7 years, I think it's pretty good. So what's my game plan? After taking a look at their numbers and current situation, what am I going to do? I think I alluded to it multiple times in this video, but I think their business model and reoccurring cash flow fee-based revenue system from their franchisees, to me, it reminds me of Visa and MasterCard. It's a toll booth company with hardly any physical operations. So in a weird way, I categorize them and look at them as if it's a software as a service company, because essentially that's what they're doing, right? They're the ones that are taking care of the online reservations, the website, the cybersecurity of people's financial information, the marketing, like that's what they're taking care of. They're not taking care of the hotel buildings themselves and the staff, and is your towel white or is it brown or is there a stain on your bedsheet? They're not doing that. They're not in the down and the dirty. That's the franchisees taking care of that. However, I don't want to be naive or be too overly optimistic because they do operate in the hospitality space. So, as a result, consequently, they're going to be more sensitive to economic shifts. or if anything happens to disrupt or ruin the travel demand, they're going to feel it. Because if their franchisees suffer, the fees that they pay to Wyndham is also going to go down a little bit, because I think it's like 5% of their gross sales. So if their gross sales go down, then the fees that are shipped over to Wyndham also going to go down. So thinking about it realistically and also optimistically, but also taking into account their numbers, I like Wyndham a lot. As a matter of fact, I'm going to put them on my watch list, and eventually I will be buying into them. I think my personal buy price is going to be around like $70, $71 a share. However, I will say this. I'm not going to be putting them on my watch list with like a sense of urgency of like, I need to buy them today, right now, or at any price. As a matter of fact, for Wyndham, I think they're going to be like company number 10 or so on the priority list, which means there's 9 other companies that I would buy into once they go on a dip before I even consider or think about buying into Wyndham. All that to say, please do not follow me into this. They are not an A tier, they are not an S caliber company. They do have inherent risks. Do your own research and homework to figure out if you like Wyndham, okay? For me, I like them. I think they're pretty darn decent, and their business model makes a lot of sense. And I guess my question to you is, are you invested into any hotel stocks? Are you an investor of Wyndham? What do you think about my analysis? Poke holes in my theory. Poke holes in what I said today. Other than that, before I sign out of here, why am I wearing this green soccer jersey? Huge fan of the Seattle Sounders, okay? And they're going to be partaking and participating in the FIFA Club World Cup. And I'm excited, but I'm also grounded in reality because we're going to get our butts a belt-to-ass spanking. Because we're playing against Botafogo, a Brazilian side that is actually really freaking good based on my research. We're playing against the La Liga team Atletico Madrid. Dude, they're going to absolutely wreck us with like their C team. I don't think they're going to use their starters against us. And we're also playing against PSG. Yes, the team that just won the Champions League. So I think it's going to be a rough couple of weeks. But that doesn't mean I'm not going to support my team. I'm still going to be like, yeah, let's go Seattle. But all that to say, if you appreciate what I do here on YouTube, would you consider becoming a member of the Patreon family? If you want to hear the full pitch as to why Patreon would make sense for you, but also for me, then check out the video that's going to be included into the pinned comment. With that said, I'm going to sign out of here so I can edit this video and upload it. I love you guys. Stay safe. I hope you and your families are doing well, and good luck in the stock market. Peace.